that U.S. stocks getting to, and then they fade. The rally is just not sustained. Where do you see it going now that we have more positive eco data?
It's interesting. The market's rally, I think, is losing some steam as a consequence of basically a market cycle, an economic cycle that's aging. You have valuations that are full, a little bit of complacency in the markets, and you don't have a catalyst of earnings growth right now. We had a contraction last quarter. This is the third contraction in a row. And you have some risks hiding in plain sight that I think investors are concerned about. So I think it's a watchful waiting period of time.
What did you make of the data that we had this morning? Because we saw households just going on a spending spree in April, but at the same time, just consumer confidence slipping to what, the lowest since February 2014. What does that tell you about sentiment here in the U.S.?
We've had this trend go on for some time, mixed data. It's been an economy that has not fired on all cylinders. The good news is the consumer seems like it's actually in very good shape. It's the backbone of the economy. That and housing are catalysts for this recovery to continue and have an elongated pace. But the problem is we haven't hit on all cylinders. And so the manufacturing side, the export side, the business investment side has been weak. And that's sort of holding back our potential at this moment.
So how do you pick stocks in this environment?
You know, at Highmark, we're patient, contrarian, long-term investors. And so we're looking to buy high-quality assets at misprices that are mispriced temporarily for events and risks that we think are fleeting. Today, we favor value over growth. We think value is an interesting place to play. We like cyclicals over defensives. And we think there's a lot of value in those areas of the market.
You're underweight emerging markets, but at the same time, you favor international stocks over domestic. Does that mean that you're going to Europe, you're going to Japan?
We are underweight Europe, a little concerned, or underweight, I should say, emerging markets. We're a little concerned about the debt levels in emerging markets. We're a little concerned about the growth slowing there. We're concerned about potentially a shakeout from a credit cycle. Developed market international is sort of interesting to us, Europe specifically. So it's undergrown this cycle, and the earnings are about 20% from the prior peak, whereas the U.S. is 25% above the prior peak. So they haven't enjoyed an earnings recovery like we have. And a lot of the events that have held them back, whether it's sovereign debt risk, the financial crisis, and things of that are behind them, and hopefully in the process of normalizing today.
Not a possible Brexit.
That's a risk, obviously. The voting seems to be trending in favor of staying. That would be highly stabilizing for Europe. So we'll wait and see what happens there, but it is a risk.
What about the China risk? Because we saw just so much volatility there, just stock futures plunging and then going back up. Do you think there could be contagion to the rest of the world as it happened in January, as we saw in August?
It's a concern. China is indeed slowing. Their financial system is highly levered, so that is a risk. They're trying to rebalance their economy towards consumption and services, and that's going to take a long time, and you can't do that overnight. So with all the tremors and the stronger dollar a concern, that impacts the Chinese market. What they're worried about is the peg to the dollar and the yuan becoming too strong and forcing them to be uncompetitive. So a response would be obviously to loosen that peg, and that could be highly destabilizing. That's something we're watching from a risk standpoint.
Yeah, I mean, another big devaluation that could be huge for global markets. But we're seeing currencies just having this oversized impact on the equity market. So how do you play that?
Yeah, it seems like the dollar and currencies, the dollar is the new transmission mechanism for the Fed. And so you have to watch them very carefully. It's impacting currency markets, fixed income markets, and equity markets. We're not trying to play currencies per se. We're just watching to see what the consequences of currency moves. You know, we had the dollar move up 20% over the course of a year, roughly about a year ago. That's a highly destabilizing event and impacting markets around the world. So it's something to watch. It's hard to predict, but something we're handicapping very closely.